macroeconomics. I will state and preface this by saying to you, I am not a Republican. I am not a Democrat. I am an American. And this is information financially that every single person in the world should know, should understand, should be aware of. And by the time that I am done, I've done this speech a few times now because I used to do a podcast, which actually Jay built a podcast studio for me here at King. So I'll be launching a Rice report on economic breakdowns 5 days a week, starting in a couple of weeks.
Wow.
In our own little studio in our new office. But when I'm done with this, I'm going to guarantee that all of you who are listening to this right now, you're going to break into 3 different factions. A very small amount of you are going to go, I already knew that information. A large amount of you are going to go, I've never heard that before. And another small amount of you are going to say, I think he's full of crap. And I will let you know as we're going through this. As I'm talking about topics, I will tell you with evidenced proof and date stamped and time stamped information that these are things that I've talked about for quite some time. So I'm really happy that people are starting to open their eyes and pay attention to what's going on in the world. Because just like you said, the world is changing. We refuse to see that as people, right? You know, I was born in 1977. And since 1977, the world's changed dramatically. Yet every time big changes come, we all look at it and say, oh, that's never going to change. Nothing's ever going to change. And change has 2 sides. It's either good or bad based on your perspective. So, for me, looking at this information I'm about to share with you, this has revolutionized my life. It has put me into a different perspective on where I put my money and what I put my money into. And I hope it does the same for you. So I'd be more than happy to get started. I'm going to zoom through it. I'm from Chicago originally, so I talk really fast. Exactly. Very fast. I'm going to get through this information quickly because I want to get to 4 or 5 questions at the end. I'm positive that many of you will have 1,000 questions, and I'll be more than happy to answer them some at a different time. But again, we have our quarterly business review in 52 minutes. Yeah. And as a chief growth officer, I should certainly not be late. So let's go ahead and get started.
Awesome.
Let me see if I can, there we go. I can share my screen.
Yep.
And let's get it started.
Awesome.
So this is a macroeconomic environment overview. And I believe, and I'm not the only one, but many people believe that alternative investments are the new normal. And I'm going to walk you through that. That's the premise of the conversation to begin with. But the information I'm going to run through is fast and furious and a little bit hectic. So if you have questions, please feel free to type them in the chat. If we can't get to them today, I'll be more than happy to do some voice recordings or answer you in person or just talk to you on the phone and walk through some of these ideas with you. So the recent state of affairs, I don't call it the current state of affairs, but the recent state of affairs. We have to acknowledge history is history, and history is being made every moment. So first we had a pandemic. This pandemic, there's different views on it. I have my own. Again, I'm not going to be political with these things, but we had a pandemic. What I like to call the pandemic is actually a black swan event. People always are in fear of black swan events. And if you don't know what that is, that's a major geopolitical or major event that causes disturbance in markets or collapses of markets. Now, during this pandemic, you can't argue with the fact it was a black swan event because global economies shut down for months. That's the first time that has ever happened in human history. The repercussions of this pandemic from money printing and stimulus and all these other things has caused a tremendous amount of global inflation. Traditionally, inflation is held to regional or nation-specific economies. Right now, every economy in the world is experiencing massive inflation. And inflation isn't reported properly. I hate to tell you that. It hasn't changed since 1972. All kinds of things I'm going to walk through you may not know. I'm a big history buff. More importantly, if you think I'm wrong on something, I have no problem with you proving it to me and me changing my mind. I absolutely am. I'm not an economist. I'm a independent critical thinker that pays attention to absolutely everything. So following a black swan event and inflation, we're now starting to see civil and national unrest. Many of you may not know some of the things that are happening around the world because the news doesn't share it with you very often. But right now, this morning, 34 rockets were fired into Israel. We're seeing many different physical kinetic conflicts in Iran and Syria. Obviously, Ukraine and Russia is a big story, one that needs some more information in detail. But at the end, we're starting to see civil unrest in Paris. Right now, the city of Paris is kind of on fire. Macron signed an executive order moving back the age of retirement. There's all kinds of political corruption that's being exposed around the globe, and that's causing a lot of unrest, and that's something to keep an eye on. So As we had an administration change, and again, I'm not being political, I'm just stating facts. As we had an administration change, this new administration came in and took out 25% of the oil industry by shutting off the Keystone XL pipeline, restricting federal land usage for drilling in Utah, Alaska, parts of California, the Gulf Coast, and off the coast of the Atlantic. So these are big implications in history, especially economically. Along with this shutting down of 25% of domestic oil production, we've also been selling out of our SPR, our Strategic Petroleum Reserve, since 2021. We are now at the lowest levels in almost 50 years of the SPR, and a majority of the oil we've sold out of our Strategic Petroleum Reserve has actually been to the nation of China. Now, the Strategic Petroleum Reserve is actually designed for national emergencies and times of war. So as we're approaching what could be nuclear war, I have no idea. I'm not here to make, I have a fundamental saying in my life: prepare is better than predict. Understand what's happening out in the world, prepare for it. Don't try to predict when it's going to happen. Just be prepared. It allows you to sleep better and to be a better father and all these other things, as long as you're prepared for whatever may come. But our Strategic Petroleum Reserve, as we're approaching potential war with China and Taiwan, potentially America getting involved in these things, we simply don't have the oil reserves available to fight a war. The most valuable commodity in times of war are not bullets or missiles. It's gasoline, it's fuel. And we simply don't have enough stored in this nation and pretty much every other nation around the world. Now, there are conflicts that are brewing, obviously Russia, Ukraine, Syria, Iran. We're seeing Lebanon and Israel today. We're also starting to see regional conflicts throughout the entire Middle East. We're starting to see China and Russia become allies, which is they're kind of mortal enemies, historically speaking. And we're looking at potential US involvement, sending our troops off to these foreign wars again. Now, I preface this by the way, this is my favorite slide. My slides are basically pretty simple images. So I want you to listen, not necessarily read the slides. This slide by itself tells the story that we're in right now. As you can see the globe in the back, this is a global event. This is not restricted to any region. And this is a war. That's why we have the tank. But it's not a war like you think. We're in what's called fifth generation warfare. There's a lot of psychological and economic warfare taking place right now that no one's labeling that. And that's exactly what it is. And I will walk you through that. In the midst of it all, you will see gold stacked up on there, also is playing a very large part in the world that we live in today. So this whole story begins in 2020 to 2021. We printed an excessive amount of money for stimulus, for all types of other things. Now we're printing money for foreign wars. We're printing money for all kinds of things that actually don't serve our nation. If any of you don't know what that building I'm showing you is, that's the Federal Reserve. The Federal Reserve, from my perspective and my opinion alone, is an institution in this country that is not necessarily needed. Our Federal Reserve is actually a private bank that prints money, puts it into circulation, and then the money that we earn with our sweat is what we pay back in taxes. So I want you to remember the fundamentals. The Fed prints money, puts it into circulation, you earn money and pay taxes back, which is supposedly going to pay them through the IRS. But this is important to note because essentially all they do is print money. When you have a place that prints money, there's really no repercussions. However, the way that they run their own investments is of massive concern to us. To put it simply, the Federal Reserve's balance sheet, they've been lending money at 2% and borrowing money at 4%. Just as a basic example, a really simplified version, but the Federal Reserve's balance sheet is in absolutely atrocious shape right now with a little over $1.25 trillion in unrealized losses. Now, I remember growing up, everyone wanted to be a millionaire. That was the thing. You wanted to make $1 million in your life. Well, $1 million is not a lot of money anymore. Then everybody wanted to be a billionaire. Now we're approaching the era of trillionaire, and our government is printing trillions of dollars. Matter of fact, when we spend 100 billion on something, it doesn't even faze people anymore. This inflationary trend is very dangerous. To put money into perspective, if I were to take a stack of money and count $1 per second and reverse time, if I were to do that, if I counted $1 million, I would reverse time 12 years. If I were to print $1 a second at a billion, I would reverse it to 1971. $1 trillion would put me back 31,000 years. So the multiplying factor of going from millions to billions to trillions in uncapped spending has produced a really sticky situation, not just in this nation, but around the world. And now we find ourselves in the midst of a political war for a debt ceiling. Some people don't know what that is. A debt ceiling is basically the limit on our credit card. The Federal Reserve is our Visa. Congress are the spenders, and the taxpayers are the repayment makers. That's the way our system works today. And our debt ceiling has been met, meaning that the agreed upon level of borrowing that Congress can have from the Federal Reserve is capped. We have reached the limit of our credit card. There are debates going on left and right to raise the debt ceiling or to eliminate the debt ceiling. All of these are dangerous. We need to pay off our debts. We are on the verge in June or July of this year of not being able to actually make our interest payments to the Federal Reserve, which will trigger some massive global downturns around the world. But let's look at the debt ceiling for what it really means. Knowing that Congress requests money from the credit card, the credit card, produces the money, and eventually you have to pay the credit card back with interest. So the money in this country isn't even our money. We're paying interest on it. Now, the only way that that interest is repaid is either from further borrowing, so borrowing from Peter to pay Paul, or it's from raising taxes. Now, when the debt ceiling is met, which it currently is, you're looking at a scenario where they have one play to be able to make payments, and that's to raise your and mine taxes. Keep that in mind, very important. Along with this, we're seeing inflationary trends, which, to be honest with you, I'll go through in a later slide. It's pretty difficult to actually trust a lot of these reports. Inflation, as you can see, in 2020 was at 0, 0.3, 0.6, and now we're at 6% theoretically. However, inflationary tracking hasn't really changed in about 45 years. We still track inflation the same way we did in the 70s and 80s. In a wildly different world, inflationary tracking should be done differently. If you'll notice, if you go to a grocery store, the price of eggs isn't up 6%, it's up 350%. The price of orange juice is up. The price of all commodities-driven food-based products are up tremendously higher than 6%. So that's a global a domestic overall look at inflationary trends. Now, in order to combat inflationary trends, the Fed has to raise interest rates. So printing money into the system, they give it a fancy name called quantitative easing, meaning they're making it easier to borrow money. That happens in times of low interest rates, which we saw stagnant from 2009 to 2015, completely stagnant, just barely above zero. Now we're starting to see a spike, and that spike is occurring because they're doing what's called quantitative tightening. They're raising interest rates to recoup more payment back to the Fed. When this happens, you have a very strange scenario brewing. So we have high inflationary rates, which are probably going to get worse, to be honest with you, and they're not even labeled properly. Many economists are stating that we're already at 14, 15% real inflation, and that could be higher. But now we have the Federal Reserve raising rates, which here at Sugo, primarily real estate investors. So you're feeling the pain of new mortgage rates. You're feeling the pain of credit card rates. Credit card rates, by the way, are the one thing you should watch. I'm going to show you in a later slide. Very important to the overall economic position of this country and globally. So with these higher interest rates, it's supposed to lower inflation, to remove money from the system. It's not really working, nor do I believe they're going to stop. Now, this puts the Fed in a very difficult position, a rock and a hard place. I love this slide. I'm a big Simpsons fan. So seeing Homer bounce back and forth from a rock and a hard place, I wish I could play the video. It's kind of funny. But the Fed finds itself between a rock and a hard place. If they lower interest rates, they're going to stimulate and accelerate inflation. If they raise interest rates, they're going to torch the economy, because many businesses out there, as we just saw with Silicon Valley Bank, don't actually run their businesses on revenue and profit. They run their business on working capital loans. So if those loans become more expensive, we start to see economic hardships that ripple effect through the entire global economy. So what does this all mean when they're between a rock and a hard place? They can't raise interest rates to lower inflation. They can't lower, or they can't raise interest rates because it'll torch the economy. They can't lower the rates because it'll stimulate inflation even further, which means that because we're at a debt ceiling, the only thing that's going to happen relatively soon is they're going to start talking about raising taxes, which I believe will happen near the end of 2023. This also means that in high inflationary times with high interest rates, that the buying power of the US dollar is deflating by the moment. This is happening without global events, which are going to seriously impact the value of the US dollar. We need to keep our eyes on these things and be very cautious of our spending and be very conscious of what I'm going to talk about at the end, which is what hard assets, things that you can touch and feel. Now, since we have the Fed's position on things, let's look at the United States average citizen. Right now, 74% of Americans live paycheck to paycheck. And I'm assuming that's probably not many people on this call today, if any, but people who live paycheck to paycheck, which I grew up that way, and I've been there a few times in my life. You're pretty much out of money on Wednesday and waiting to get paid on Friday. This is a very delicate situation to be in. We're at almost $17 trillion in household debt. This slide is literally only 4 weeks old from these stats, and we are now over $1 trillion in credit card debt with rates going up. Last month alone, there were almost 4.5 million auto loans that were 90 days late. This is a very trying time for not just this country, but around the world, but especially here in America. We're looking at a period in time where people simply do not have discretionary spending capital. What does that mean to the world? Well, that means it affects what are called traditional or conventional investments. The average investor thinks of investing as stocks, bonds, and cash. Stocks, bonds, and cash are in horrible situations right now, all three of them. Many will see that the bond market is in complete triage, $17 billion, which is wiped out from Credit Suisse. They'll see that the stock market is still flourishing, but I'll explain that to you in just a moment as to why I believe it hasn't dropped as of yet. But it will certainly, because the charts tell us that, and the charts are pretty darn accurate. But these three investments that we're seeing right now, the traditional or conventional investments, are in grave danger, especially stocks. Stocks by themselves, the reason I showed the slide about consumer finances is because most discretionary spending creates corporate profits. When people have money to spend, they spend it. Right now, their credit cards are tapped, just like our debt ceiling, and they are in a position right now where spending more money isn't really an option, and that's for 74% of the country. So if we're in that type of situation, the stock market, stocks like Netflix and Disney and places where you're spending money you don't need to, those places are losing user base pretty consistently and losing revenue, making the stock market a difficult place to navigate. The bond market itself right now, the average corporate bond rating, this is a rating done by S&P and Moody's, is BBB. So the average, if you take every corporate bond in America and you average them out, they average a BBB rating. That's one step above junk. So the average corporate bond is almost junk. The US Treasuries, which is where has been a safe haven for store of value for generations, literally generations. If you don't know how they work, the way that a bond works is when the yield goes up, the value goes down. When the value goes up, the yield goes down, like a triple beam. Right now, we're seeing the news will tell you that, oh, the rates are getting better on US Treasuries. Well, the actual value is going down. And that's costing us banks. That's costing us all kinds of sovereignty around the world and national security at one given point, because a grand majority of our US government bonds or treasuries are purchased by other nations. So Japan and China own a significant amount of our debt, and they're selling it in the open market for the first time in a very, very long time. Cash is a topic I'm going to cover very much in detail in the next few moments. So let's look at the stock market. And I know this is a bit of a fuzzy slide because I did it on my phone and I had to stretch it out. That does not say bull crap. It says bull trap. So these are statistical analysis of our charts. You can see in 73, it also goes back to 29 and to 1987. I just wanted to put 3 up here instead of all 5. All 5 charts align in the same exact position based on economic trends. The trends that we see right now globally are actually worse than 2008 and worse than 1973. But as you can see, we're positioned perfectly for a bull trap. They are things that occur in the stock market pretty frequently, but yet we haven't seen much of a decline in the stock market yet. And I'll go through that. So let's look at things that are supposed to be standard and things that we can trust. The GDP report. I talked about this. I think I talked about this in our webinar for King. The GDP report is generally a basic statistical analysis of money in, money out from the country. Our last GDP, ironically, occurred right before an election. And it came out and told us that our economy had grown 2.6% after 3 consecutive, a 0% growth, and then 2 consecutive negative growths, which tell you you're in a recession, period. They changed the terminology on Wikipedia to redefine a recession. We are in a recession. I hate to be the one to break it to you. The news doesn't have the courage to do it, and they can't do it because there's a board, I believe it's called the EDRA. I don't remember the name of it, but I will, if you ask me for it, I'll certainly find it for you. There is a governing board of unelected officials that determine publicly whether or not we're in a recession. Just think of how crazy that is, right? So the stats don't matter and 100 years of economic study don't matter. This board has to tell us whether or not we're in a recession. I'll tell you we're in one, and we're approaching something probably worse than that. So the GDP, let's get back to that. Right before an election, after 2 consecutive losing, shrinking economy reports, we all of a sudden grew by 2.6%. That actually is true based on the GDP report, which I actually read. But I will tell you that in that GDP report, there were 3 things that if you remove them from the GDP report, it will actually show that our economy shrank by 8%. And those 3 things are the largest ever sale of liquid natural gas in the history of this country to foreign lands. Now, what happens, I'm in the oil and gas industry. We drill gas or oil, we put it in a pipeline, we truck it out, somebody else buys it after we get paid. What the government was doing was going up and buying a lot of our natural gas because the Nord Stream 1 and 2 pipelines were blown up in Germany. We also saw 4 pipelines explode in the gigantic earthquake that took place in Turkey. So they're very short on natural gas over there. But there's a major profit built in there because the price at the time was about $5.50 to $6.50 for 1 unit of natural gas, which they were selling to Europe for $30. So big profit put in there, and the government's the only one that reaps the benefits of that. There was also a major weapons sale to NATO nations. If you again, only the government profits on that. And the third was the sale of our oil from the SPR to foreign nations. If you remove those 3 events from the GDP, you see a shrinking economy. So you can see how stats can be inverted and manipulated to prove a positive point. The most recent example of this, in my industry, I see it all the time. The EIA continually comes out and tells us about a new petroleum inventory build, this huge build, and you look at the report and you see it's a 1.7 million barrel build. That's not a big build. We use 18.6 million barrels of oil just in America, day in and day out. A little over 103 million barrels worldwide daily. So having 1.7 million barrels sitting off in an inventory somewhere is not, statistically speaking, a large build. That is just simply a build. So words matter. Now, the most recent jobs report in January, they came out and said that 517,000 new jobs were added. I want to remind you that they predicted 281,000 new jobs to be added, but all of a sudden, 517,000 new jobs. During this time frame, the head of the Philadelphia Federal Reserve resigned. And when he resigned, he stated that last year in 2021, the administration had published reports saying a little over 1.2 million jobs were created, but the actual numbers were a little over 10,000 jobs. So there's a very disturbing trend in information that we're getting from institutions that needs to be critically thought about and reevaluated. Now, why do I bring this up? I bring this up because these reports feed algorithms. I'm assuming because you're Sugo. By the way, I'm a former tech guy. I'm not a lifelong oil and gas person. I'm in this industry because of everything I'm talking to you about, and I'll explain that near the end. But when you look at algorithms, they trade 91% of the stock market is traded via algorithm. And these algorithms, their primary source of information that they scan through and evaluate are government reports. So I believe that, and this is just simply my opinion, I have no evidence of this, but I believe that these, number one, I know these reports are misleading at best, because we can look at the jobs report and find out that here's another example. They came out and said that federal agencies told us that retail sales were up 3.5% month over month this past year. Well, I'm in Dallas, Texas, and I go between here and Houston quite a bit. In every downtown area I go to, about 60% of the retail spaces are for lease. So I don't know exactly how that's going to happen, especially while Amazon is losing billions of dollars in market capitalization because they're not bringing in as much revenue as they used to. But somehow retail spending is up. It's another key indicator for algorithms. So keep that in mind. Now, we've all talked about and seen Silicon Valley Bank. I was a former customer of Silicon Valley Bank. It was actually a sad day to see this happen. But the day it happened, major banks, Wells Fargo, Bank of America, UBS, all these other large banks lost $47 billion in market cap the day that happened. Signature Bank was the next to follow. Signature Bank, I'm going to preface this in just a moment. Signature Bank lost a ton of value as well at the same time, losing depositor credit power. Now, neither one of these two banks really did anything wrong. The thing that I see in this situation, when you look back to 2008, banks were buying really risky short-term and some long-term risky, triple B type investments in mortgage-backed securities when a mortgage crash came. That didn't happen this time around. That actually was an understandable crash in 2008. In 2023, The crashes that have occurred and will continue, there's a list of 321 banks that are actually insolvent right now that will probably be going through the same restructuring as these two major banks. They didn't invest in long-term or short-term risky securities. They invested in US Treasuries. So when the US Treasury raised rates, raising their interest rate on the bonds, their bond portfolio lost a ton of value and they could no longer support their deposits. So while everyone kind of blames these banks, they didn't really do anything really risky. They invested in what is considered the most secure investment in the world. That should be a real big eye opener for anyone out there who has money at play. Then we saw Credit Suisse get bought up by, I believe, UBS. But the day that they did it, in order to clean up their books, with the stroke of a pen, they just wiped out $17 billion in debt to bondholders. So if you were a bondholder and you put $1 million into a Credit Suisse bond, expecting to get paid over a 20 or 30-year period, you're getting nothing. You're getting a tax write-off. That's what's happening. This is a very, very trying time. And at a later date, I'll be happy to go through the Dodd-Frank Act and what that means for banks moving forward, because it's an eye-opener. What the possibilities of there are no more bank bailouts. That was made impossible through Dodd-Frank. The next phase that they have to recoup is what's called a bank bail-in, where they get to convert their debt or your deposit into an equity. And this brings up the topic of BRICS. So many of you have heard of BRICS. Many of you have no idea what I'm talking about. Well, in 2001, the nations of Brazil, Russia, India, China, and South Africa got together and said, you know, we're being bullied by the United States, which is a fact. We bully people with our currency as the global reserve currency. Our currency accounts for 60% of all value. The US dollar accounts for 60% of all value around the world. Almost all international trading is currently done with the US dollar. Now, 2 weeks ago, I would have said all international trading, especially in liquid natural gas and petroleum products, 100% of that used to be done in the US dollar. BRICS is a mounting force that people need to pay attention to. There's people who say they're taking over. There's people who say they're nothing. I don't really have an opinion. Again, prepare is better than predict. What I can tell you is that the BRICS nations are mounting a very strong effort to put the pressure on the US dollar. One thing they've been doing in all of these countries for the past 20 years in Russia and the last 7 years in the other nations, they've been accumulating a tremendous amount of gold. And by tremendous amount of gold, I mean hundreds and hundreds of metric tons of gold. And the reasons are pretty simple. You know, when we go to war, we'll take Ukraine as an example. When we see someone at war, we're not technically at war with them, although not technically we are. When we look at the Ukraine-Russia conflict, where we are right now, what was our retaliation? Did we send in planes? Did we send in troops? We sanctioned. We used the power of the US dollar to try to shut down Russia, who's actually prospering at the moment. Their economy is growing while ours is shrinking. Those are simple facts, not a political statement. But while that happened, we saw Russia about a year before the conflict really start bolstering their purchasing of gold, along with China. Brazil is now a partner with China. The reason they're doing this is twofold. Number one, they're doing it to avoid the penalties of sanction. Because from nation to nation, if you needed to purchase something and they used to only take US dollars, they'll always take gold. So these nations have been stockpiling as a way of protecting themselves against US economic sanctions. They've also been speaking very boldly and very publicly for the last 2 years about creating a gold-backed currency to compete against the US dollar. Now, we've heard these rumors for 20, 30 years. They're actually in play now. This is now becoming a bit of a reality. This is the main reason I wanted to talk to you all today, is to go through what's truly happening. So recently, China brokered a deal between Iran and Saudi Arabia. And if you're not familiar with the regional landscape there, those are the Sunnis and the Shiites. These are two factions of Islam that have been warring against one another for thousands of years. China came in and brokered a peace deal between the two. Now, if we look at Iran, they've had the US dollar sanctioned against them for about 7 years now. They are now using the Afghanistan withdrawal as a way of shipping their oil to Afghanistan and selling it to China. The stuff is definitely happening. Last week, France actually teamed up and had a $60 billion liquid natural gas sale to China in the yuan, meaning that for the first time since the 70s, somebody exchanged a petroleum or gas product not in the US dollar. This is not a small thing to ignore. Many economists will say, oh, this has never happened, not in my lifetime. Now we also have 29 nations in the past 3 weeks. When I gave a speech at Rice University, I said during my speech, you will see more countries in the coming weeks start to speak boldly about not using the US dollar in trade. While I was speaking, 5 nations actually put out press releases. I also said that they will probably arrest Donald Trump as a way of not speaking about this in the news. And I'm pretty sure all of us have noticed that that has dominated the news cycle for the past few days. So these are things I want you to pay attention to while the rest of the world wants you to pay attention to some trial in New York that actually doesn't impact your life at all. But the value of currency does. We've also seen Brazil and Russia have now agreed to do all trade in Chinese yuan. All trade, not the US dollar, all trade between those two nations. And we've seen Saudi Arabia and China agree to sell Saudi Arabia oil products to China in the yuan. These are significant historical moments that are not being talked about in the news, and they will impact us eventually. I don't know how severely, but I have a good idea. So referencing this again, you'll see that recently in the past week, we have seen Saudi Arabia, the UAE, Egypt, Argentina, Mexico, Nigeria, the list goes on and on. There's 29 nations now that want to join the BRICS Alliance. The BRICS Alliance purpose is to compete against the US dollar for global trade. We all have US dollars. We should know this information. So what happens if, well, let's just look at the scenario. What happens if, for instance, there's a gold-backed security or gold-backed currency somewhere in the world? Well, considering that our currency in 1970s was backed by oil, removed from the gold standard in 71, and then backed by oil because of our alliance with Saudi Arabia, who the world thinks has all the reserves in the world. When that changes, things change. Just like Sarah said earlier, the world is changing. It will be different 5 years from now. I don't know what that looks like. I'm not trying to predict it. But if there were a gold-backed currency somewhere in the world, it would certainly compete with the US dollar, which is essentially fiat at this point. This would cause what's called repatriation, meaning that right now, again, 60% of our dollars, all the dollars in circulation exist in foreign nations. They're a store of value. So if 60% of our currency isn't being used for international trade, what happens to the currency? It will be repatriated back to the United States. That will further embolden the inflation rates that we see today. They will continue to rise. Matter of fact, they will spike if we see that. And I'm not saying we're going to, I'm saying if we do see that. Now, if we see a competitor for another global reserve currency, which my personal opinion is we won't see. I don't believe that nations around the world want a global reserve currency because we've had it since World War II, essentially. And since World War II, we've pretty much bullied every nation in the world using economic sanctions. I don't think these countries want that type of tyranny over them. And I think that what we're seeing right now is a move towards blockchain technology. I believe that we're moving towards tokenization of physical assets, so that people don't need the SWIFT system, which if you're not familiar with that, if you've ever sent a wire transfer, you get a SWIFT code. The SWIFT code allows US dollars to be wired anywhere in the world in milliseconds. That payment system is coming to an end because it has a competitor. It's called Sucre, S-U-C-R-E, that has already been built and established. But I think what we're going to see is blockchain and crypto technology tokenize physical assets, so that if I'm in Taiwan, for example, and I want to buy US hard manufacturing equipment, that equipment will be tokenized with a value on it. So I will be able to put Taiwanese capital into a system, transfer a token, it gets downloaded into US currency. That is, most of you are very up on tech, so I'm assuming that you're on board with that idea. I think that is the future. But that type of process will cause a repatriation. Now, repatriation isn't a brand new term. Countries around the world have been repatriating their gold for about 15 years, including Germany, France, all types of other places used to hold their gold in other nations as a secure storing spot. They've been repatriating them for the last 15 years. And I will tell you this, that high level of government people know what's happening way before we do. So in the end, what I think we see, if we see repatriation and a competitor for the US dollar, which we clearly see, that is clearly an economic activity occurring, not a theory any longer. This is going to cause a lot of things, a lot of hardships. So I want to cover what would happen if, for instance, and this is might sound scary, but as real estate investors, I think I'm one of them. I think it's actually an opportunity. If we saw the US dollar hypothetically lose 10 to 15% of its value, and by the way, it just dropped 50 cents the other day and gold and silver went crazy. I'm writing an article on gold because I've been buying gold for 2 years and everyone's laughed at me. But gold is only $40 off of its all-time high right now. And I think you're going to see it spike through the roof eventually. Now, if we see repatriation, that'll cause inflation. But even just the weakening of the US dollar by 12%, let's just hypothetical number. That means that your dollars have 12% less value, which means that's causing more inflation. If 74% of our country lives paycheck to paycheck and is in tremendous amounts of credit card debt, which are now at 25, 30% interest rates, you're going to see, number one, you're going to see a weakening dollar will cause layoffs and unemployment. Companies won't have the buying power they once had. There are now less banks that are able to lend, and lending costs more money because of interest rates. So we're going to see layoffs. That is going to come. It's already started in the tech sector. It's going to hit every sector eventually. But when layoffs occur, what is the ripple effect? The ripple effect of layoffs and a lowering of buying power and an increasing of cost of goods, you're talking about bankruptcies and foreclosure waves, maybe like we've never seen before. And that's an opportunity, of course, for property buyers. That won't be tomorrow. It'll take some time for all these things to unfold and happen. But at the same time, if people have less money, no jobs, no home, are in bankruptcy, making payments back or not, we will start to see a rise in civil unrest and chaos. And that's just a fundamental theory of how finances impact sociological events. If that were to happen, we already have conversations about this. This is something everyone should know about. It's called a CBDC, a central bank digital currency. Our government has already instilled what's called a Fed Now program launching in July. This isn't a myth or a theory. It's already booked. They're already putting out advertising for it. The advertising is that this will replace your Zelle and Venmo, and you'll be able to make payments anytime you want, but it has to be done in a central bank digital currency. Now, the Fed Now program, otherwise known as OP 1670, feel free to do research. OP 1670 basically takes your personal banking information and shares the data with our intelligence agencies, meaning that they have full control over your banking rights. A central bank digital currency, a digital dollar, isn't a bad idea. We're moving towards digital assets as is. That's just part of Moore's law. You can't stop. However, a digital dollar is much different than a central bank digital currency. And I think what we're going to see, if the dollar does weaken, I hope I'm wrong, by the way, I hope I'm wrong, but if the dollar does weaken and we do see layoffs and we do see foreclosures and we do see people with less money, hurting to get by on their day-to-day expenses and civil unrest, this will be a perfect time for a government to say, hey, sorry about the dollar. We've got this new CBDC. We can put it in your bank account today, just sign here and give away rights. I mean, that's kind of how it works. When the government has control of access of your data, read OP 1670, research it online. If you said, I don't like Ukraine, or I don't like Russia, or I don't like Joe Biden or Donald Trump, or whoever would be in charge, they would have the authority to shut down your bank account because they disagree with you. This is already happening. The ban TikTok bill is not a ban TikTok bill. That is a restriction of free speech. Research these things thoroughly. They will impact your economic life. A CBDC is sort of the end of financial freedom. It's programmable money. If they don't agree with what you're doing, if you go to the doctor and it says you're overweight, the money probably won't allow you to buy ice cream. That's kind of how it's working. That's how it's been built and designed. And if you think I'm joking about any of this or it's conspiracy theory, I can show you a video of the head of the BIS, which is the Bank of International Settlements, which is the central bank of all central banks, who made a quote saying, we need to get to a CBDC because right now people can take $100 bill and they can spend it anywhere on anything that they like. And that type of control simply won't be accepted. So they want to have control of capital. That's kind of obvious. Again, not non-politically driven, just sovereign driven. So what does this all mean? It means this is a great time to get into things that matter, things you can touch and hold, commodities. I've been preaching gold, silver, raw land, oil and gas, and Bitcoin since before I started working here. This is why I work here, because I want to get people involved in this. If you look at our food supplies globally, copper supplies, metal, commodities, all the mining has been restricted for the last 4 years. The pandemic shut down silver mining around the world. Gold mining has been shut down by about 40%. These commodities have tremendous value, but no value rests anywhere higher than hydrocarbons. Hydrocarbons right now and any time in the foreseeable future are absolutely going to be more valuable than gold, especially as we get towards more inflection points when it comes to wars. Now, this is a series of events in oil, why oil and gas is important for your portfolio. Again, our SPR, Strategic Petroleum Reserve, is at almost a 50-year low. It's the lowest reserve report we've ever had, literally, in the SPR. We've sold this off to foreign nations and sold it off to refineries around the country to artificially lower the price of gasoline during elections. That's a fact. OPEC Plus, theoretically the largest producer of oil in the world, they have reduced their production output by 2 million barrels after our president went and visited them in Saudi Arabia. They didn't raise the number, they've decreased 2 million barrels per day. Russia has decreased 2.5 million barrels per day. Recently, this past weekend, OPEC Plus announced another 1.2 million barrel reduction of oil per day. Now, I actually don't believe these numbers either, because it's been a long known, for people who seek the truth and don't just listen to the news, a long known fact that the largest oil reserves on planet Earth are right here in this country. Between Alaska and Texas, there's enough oil under the surface of the earth to power every vehicle, building, and plane around the world for about 600 years. Don't believe me? In 2016, CNN actually published an article saying the US has more untapped oil than Saudi Arabia or Russia. I don't believe that these reductions in production are, I believe the first round were real. I believe these most recent ones are simply, like John Malden says, it's like when someone falls down the stairs and stands up and goes, "Oh, I meant to do that. Wasn't that funny?" I think they're admitting that their oil reserves have been depleted so severely over the past seven or eight decades that right now they don't have the capital to produce, and they don't have any new wells drilling. Oil and gas fight wars, they run factories, they run airplanes will not run on solar power. You will not be able to get more than 40 miles in an airplane. You're better off riding a bike. If you plan on traveling or running a business or heating your home, oil and gas is still the current and immediate future. So I won't get too much into pitching our deal. This is kind of what we provide. I want to be educational, but investing in oil and gas has three things that defend you against everything that I just talked about. Investing in oil and gas allows you 100% write-off against your adjusted gross income for your contribution. Knowing that the debt ceiling is met, inflation is high, and interest rates really can't go higher, taxes are probably going to go up. The second great benefit you get from investing in oil and gas is monthly passive income. If inflation is going to be high and the dollar possibly weakened, having more income in your hands is never a bad thing. And with us, the thing that's very unique is we actually sit on the same side of the table as our investors. We include our leaseholds, our assets, and those actually appreciate over time along with income. So having a way to reduce your taxes, increase your monthly cash flow, and continue to grow your wealth by multiples is a great place to be to offset some of these economic conditions that we find ourselves in. That's a little breakdown of what we are, but that is what I have for you today. I hope I did it in good time. I can't see the time right now, but let's open it up for some questions if we can, Sarah, if that's okay with you. Oh, you're muted, Sarah.
Yes, that was perfect. Yes, thank you, Eric. Wow, you got through a lot of information.
Oh, jump fast.
Yeah, that was awesome. So you guys, Eric has only a couple of minutes because he has to jump and do the QBR. But put in the chat or can you see the Q&A? There's actually a bunch of stuff in there.
Yeah.
Let's see.
I'll rip through them. Will I get a copy of it's recorded? Yeah, so I think there'll be
We'll send it out tonight, guys.
How about bonds? Are they a good investment? I don't give investment advice, especially over the internet. Not a good idea. But I would say that the warning I'd give you is the average rating of a corporate bond right now is BBB. That's one step above junk. If corporations don't have people spending money at their stores and people don't have money to spend on their goods, the possibility of them paying you back gets much lower. If governments have weakening currencies and new emerging currencies, the possibility of them paying you back also pretty low. I know that doesn't answer your question directly, but it does indirectly. What impact would there be on the price of oil if oil is no longer just sold in USD? Great question. The revaluation that would have to occur from local currencies to be able to purchase is en route right now. So I don't know what happened to that, but what I can tell you is that the price of oil will go up. Depending on, it doesn't matter whose currency it is. We're still going to demand US dollars for our oil here. So for us, even if we weaken the currency and it went from $80 to $90 a barrel, by the way, this is just my opinion based on living and breathing this stuff. I believe we'll see $130 to $150 a barrel oil before the end of this year. I really do. In June, we actually cross a threshold between supply and demand, meaning there's less supply and more demand for the product in June. So you can see it already rising at the gas stations right now. This is definitely a mounting problem moving forward, but I don't know what the price would be with a revaluation of currencies. If the US loses its reserve status or gets significantly devalued, do you think the US will stop being world police and let skirmishes occur until everyone gets back on USD? That's a political question that I won't get into. I personally, I'm a peace first person. I believe in nations should settle their own issues. If someone's getting bullied, we should step in. But the fact that we've been the world police for so long, nobody else pays for that. You do. Do you want to continue to pay for foreign wars so that your children have nothing left over? Because I don't. I would rather see a commission of peace, people learning how to broker deals in between nations that allow them to both flourish. That's what I would personally rather see. What is your opinion on 2.5 billion in security assistance in addition to the 120 billion provided to Ukraine in the period? I don't give my opinion. I think Ukraine is an interesting story. If you want my political opinion, I will be happy to give it to you in a one-on-one phone call. But I have been attacked for speaking my mind and the truth online for quite some time, so I don't get into anything he did. But what I can tell you is I think it's ludicrous that we are sending billions of dollars to Ukraine, yet we've sent no money to places like East Palestine, Ohio, who've been devastated by chemical spills. We're not protecting our own borders. We're protecting a foreign nation's border. None of those things make sense to me. And again, not a Republican, not a Democrat, just an American. I think that we should be taking care of our own people before we worry about others. Not that we shouldn't worry about others, but we're not taking care of our own people. I'm showing you what's coming, and we're not doing that. How do you think the Federal Reserve would attempt to implement digital currency in the US? Well, they're already doing it. So the Fed Now program, or OP 1670, is already legislation. So it's already law. It's coming into play in July. You have no choice around it. There's 145 banks that have signed up for it currently. It's coming. There's no stopping it. But in order for a nation to accept digital currency, CBDC, which is essentially monetary tyranny, they have to be put on their knees. No one would accept the ability. I don't think anyone on this webinar today would be happy if the government saw a post on social media that they didn't like and they restricted your ability to spend money more than 5 miles from your home. That's what CBDCs will do. That is part of programmable money. So in order to accept that type of tyranny, I think you're going to have to see tremendous economic downturn where people are put on their knees, where they need any penny they can get to feed their family. I think this nation is resilient. I think that we will remain a superpower for generations to come. I just think it'll be in a different way than we're used to. I know
you have to run, Eric. Do you want to run?
No, I got 6 minutes. I'll get through these. I like this stuff more. The QBR, Peter can take care of the first minute. Okay. Isn't CBDC giving the central banks way too much power? Absolutely. Who said that? RB. Yes, 100%. We should all be wearing T-shirts saying "Do not accept CBDCs" because that is the end of your freedom. But isn't China's economy on the brinks as well as their population is declining? Yes. All economies are on the decline globally. They just predicted today that global growth will be less than 3% this year. Usually that number is much higher. And even 0.1% global growth indicators are big turns. Yes, July, OP 1670, the Fed Now program. I have a newsletter. I write it for Jay. He gets his, but I'm starting a podcast in about 2 weeks. So I'll be going through these things, and it's all driven by listeners. So if you have questions, I want to answer them every day. So I'll be more than happy to take your emails or texts. Are oil and gas a better alternative than gold or gold mining? Great question. So I'm writing an article on gold of how I determined, not tooting my own horn here, but I said by the second quarter of 2023, gold would be approaching its all-time high. And we're now about $40 away from its all-time high. And once it breaks that all-time high, it's not going back. So gold I look at as Gold and silver, by the way, is a bigger upside in silver than gold. Gold and silver I look at as a replacement of cash holdings. What most people don't realize is that right now $5.2 trillion is held in money market accounts by normal people and $2.4 trillion by institutions. And that's a product of the Dodd-Frank Act. They actually secured the deposits in those money market accounts that are earning 4%, while real inflation is about 12 or 13%, probably higher. So you're losing money on buying power. So I store any cash holdings that I have that I want to reserve for, a rainy day. I'll hold it in gold and silver. And gold mining, the mining stocks, when you see a bull run in gold or silver, the mining stocks have a big upside first. Personally, on my own investment, I don't have any money in the stock market, zero. I don't trust any of it to work according to plan. So yeah, gold is just an alternative to cash. It's a store of wealth. While your cash is losing money, your gold should be gaining money. If you need that money, you can sell your gold for more cash and buy things. How much is required to invest in hydrocarbons from self-directed solo IRAs? It is for accredited investors only, $100,000 minimum. Knowing that the value of the US dollar is likely going to decline, do we think the price of gold and Bitcoin is likely to increase? Well, yeah, I do. I've been putting money in gold and Bitcoin for as long as I've been talking online, which is a few years now. Bitcoin is a counterintuitive currency to the US dollar. I believe Bitcoin or some Bitcoin is a general term I use for crypto. I personally think that there's about 5 cryptocurrencies out there that'll survive because they have a specific purpose. But gold and Bitcoin are certainly going to increase as the dollar declines. We're already starting to see this. We saw a decline on Tuesday in the dollar, 50 cents. Gold went up $44. And by the way, I buy gold every week. It's now on a 2 to 3 week back order. I used to be able to walk into a place with cash and come out with a coin. Now I have to wait 2 or 3 weeks and pre-order. So the world is waking up to this stuff. So having your cash in gold and silver and investing in things like oil and gas for the tax breaks, the income and the multiple, as well as raw land and Bitcoin, I think are savvy investors. How do you hold your gold and silver? I keep a very small amount in my home, like, a couple $1,000, but there are private vaults all around the country. About 5 years ago, companies created private vaults just like a security safe deposit box. So they have armed guards, fingerprint and retinal scanning in order to get in there. I hold most of mine in not at my home. I hold most of it in reserves or private vaults. Last one, isn't the Fed manipulating the gold and silver markets similar to what JP Morgan got caught doing? Wayne, you're dead on. Yes, gold, the true value of gold right now, if it wasn't suppressed and manipulated for the past 40 years, especially silver being used as an industrial product, the guys at JP Morgan Chase weren't caught. They were convicted and sentenced to 25 years for metals market manipulation, the largest trader in the world. So yes, I see a big upside in all 5 of the things I talked about today. All 5 of them I see, that's the only upside I see. I also see having stuff in like gold and oil and gas over that period of time will provide a very valuable nest egg for you to be able to use to buy up some foreclosed homes in the future. I mean, this is just kind of where we are economically. Everything is cyclical. That's all I have in Q&A. Oh, here we go. Some gold analysts have insisted that there should be physical rather than cash settled. Yes, I am absolutely against paper gold or silver. The SLV and all these other things you see out there, there's literally 1,000 to 1. That 1 ounce of gold you're supposedly buying with that contract has been sold to 1,000 people. So there's places like Noble Gold and some other places that are actually repositories. They're safe, secure vaults for you to put your physical gold and silver into. I would avoid the paper as much as possible.
Eric, I want to say thank you so much for speaking to the Sugo community about all of this. You can see in the chat, tons of people are saying thank you, that it was really valuable that you were able to take big macroeconomic events and distill it down into something that's really understandable and also really actionable for investors. So thank you for doing that. And thank you for, putting your time into helping people be aware and understand. And we need people like you in every industry and in every facet of life. So thank you for being that person for us.
Absolutely. My pleasure. Thank you all today. God bless you all. I got to get to our QBR. Have a great day, everybody.
All right. Thanks. Bye, everyone. We'll see you next time.